Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello my dear students, I hope all of you are doing well and preparing well for the upcoming November 23 examination. In this videos, we will discuss the RTP for financial reporting. There are few interesting questions that we need to discuss. Institute has tried to give some kind of case studies format for the questions, and it is good to have a look at the RTPs because sometimes questions as it is come from RTPs in the main examination. Apart from that, there are few small amendments, nothing great as far as the amendments are concerned, but yes, questions definitely you should watch it till the end. So first, let's quickly wrap up the amendments. Amendments applicable for November 23 examination. So there are some amendments, the summary of which has been given here in the table. The first one is they have replaced the term significant accounting policies with material accounting policies. Now I don't know why they bring in these kind of amendments just to increase your work and our work. Earlier also we used to have significant accounting policies and we used to disclose the ones which are material. Now they have said no, it is no longer significant, you will have to use the term material accounting policies. That is as far as Ind AS 1 is concerned. Then as far as Ind AS 8 is concerned, they have changed the definition of accounting estimates. Now what is the new definition? The definition is accounting estimates are monetary amounts, means we are talking about money, in financial statements that are subject to measurement uncertainty. So here we are saying to measure some items in the financial statement, there is some uncertainty. We are not 100% sure. Because of that, we are making those estimates. So here management will make certain estimates to resolve this uncertainty. So the definition has been updated. Concept remains the same. The way we account for accounting estimates remain the same. This is as far as Ind AS 8 is concerned. And some examples which we anyways have a look at it, like credit loss allowance, expected credit loss, ECL under Ind AS 109. Then NRV is an estimate. Then fair value is an estimate. Depreciation is an estimate, provision for warranty, all of these are examples of estimate. Definition, make a note of it. If at all a question comes in the examination, you are required to give this particular definition which talks about accounting estimates are monetary items in the financial statements that are subject to measurement uncertainty. Then moving on, Ind AS 12, a very minor amendment. So if you remember, there is an exception where we said the acquisition is not a business combination and then neither taxable nor deductible. There they have added a third item where they say that in the exception, the third condition that has to be met is that at the time of the transaction does not give rise to equal taxable and temporary differences. Means when the transaction has happened, it should not give rise to both sides, like taxable as well as deductible temporary differences. Means it is taxable as well, also deductible as well, both are of the same amount. That should not happen, right? So this is the third condition which is added to para number 15 and 24, where we talk about exceptions, not very significant as far as your examination is concerned. Then in Ind AS 101, first time adoption of Indian accounting standards. Now there is an amendment which has reduced the scope of initial recognition exemption with regard to leases and decommissioning obligations. So now the entity will need to recognize a deferred tax asset and a deferred tax liability for temporary differences arising on transaction on initial recognition of lease and a decommissioning provision. So this amendment has narrowed down the exception, and now wherever you have right of use asset and decommissioning liabilities, there you need to recognize the deferred taxes, right? So that is the amendment as far as November 23 is concerned. CSR rules, these were already given earlier as well. So, and in our main content, it is already there, and wherever you would have taken classes from, they would have already covered the updated content for corporate social responsibility rules because it was announced in September 22. If you are using the old material, then this amendment becomes very, very relevant, right? So this is already covered as a part of our lectures. So, there is nothing to discuss on this as such. Now, moving on, there are some other amendments which were made in March 22. Again, these are very old amendments which are already covered, and these are not new amendments. So you can have a look at it, and our lectures are already updated for this. Now, without wasting much time, let us get into the question and answers. So we'll start with the question and answers in the order in which they have given. Some of the questions are really interesting. Some of them have been like what they have given in the existing material. Mini Limited is a manufacturing entity in textile industry. Mini Limited decided to reduce the cost of manufacturing by setting up its own power plant and their captive consumption. As per market research, there was non-operational power plant in a nearby area. So there is a non-operational means it is not operating. If it is not operating means there is no output. There is no output. Hence it decided to acquire that power plant which was having a capacity of 80 megawatts along with entire labor force. So they will acquire the plant plus labor force. Okay. The power entity was owned by another entity, Max Limited. So Mini Limited has acquired the power plant pertaining to Max Limited. Mini Limited approached Max Limited for the acquisition of the plant on the following terms. In fact, today itself, we had done the second class of fast track revision, which is available for free, of course, on YouTube on business combination. So if you have any doubts on business combination, you can have a look at the lectures as well. Mini Limited will seek an independent valuation for determining the fair value of the plant. Okay. Value of other non-current assets acquired and non-current financial liabilities assumed is 11.1 and 32 million respectively. So plant, we don't have the valuation. Other non-current assets, and this we have the valuation. Consideration agreed between both the parties is 51 million. So they have agreed the purchase consideration. The first step purchase consideration is 51 million. Both the parties agreed to the terms and entered into an agreement on 1st of April year 1 with immediate effect. So agreement is 1st of April of year 1. Due to unavoidable circumstances, valuation could not be completed by the time Max Limited finalizes its financial statement for the year ending 31st March. So valuation could not be considered. Now, if valuation cannot be considered, could not be completed, then what do? We have the measurement period. We have a period of 1 year within which we can complete the valuation. Max Limited annual financial statement records the fair value of 80 megawatt power plant at 46.9 million with the remaining useful life at 40 years. So this is the value as per Max Limited financial statement. Max Limited also has license to operate the power plant unrecorded in the books. So this is something which is an intangible asset which is not recorded in the books. As on 31st March, it has fair value of 5 million. Now tell me whether this should be considered as a part of identifiable net assets. Absolutely yes. 6 months after the acquisition date, Mini Limited received the independent valuation which estimated the fair value of the plant at 54.9. Now on 1st of April, we do not have the proper final valuation. Subsequently, we have the final valuation. CFO of Mini Limited wants you to look upon the following aspects. Determine whether the transaction should be accounted as asset acquisition or business acquisition. Now, determine whether the transaction should be accounted for as an asset acquisition or business combination. Now, here, please remember, we are acquiring plant with labor force. If we had acquired only the plant, then there would only be inputs, there would not be any process. Now, always remember, a business definition covers input, process, output. Even if we have input and process, we will call it to be a business combination or acquisition of business. So it meets this criteria of acquisition of business. Then calculate goodwill or bargain purchase due to the above acquisition. So that we will have to follow the step-by-step purpose. Purchase consideration. Then what do we have? Identifiable net assets. There is no minority interest. This to comparison, we will calculate the goodwill or bargain purchase, whatever it comes up. Then subsequently, when the fair value is updated, we will again update the calculation. Pass necessary journal entries in the books of Mini Limited and prepare the balance sheet on the date of acquisition. Very simple. Determine whether any adjustment is required in case of valuation received subsequent to acquisition. If yes, pass the journal entries. Now, please remember, subsequent update when we have to do that also we have to consider, because subsequently the entity has determined the final valuation and accordingly our calculation of goodwill or capital reserve will also undergo a change. Now, they have given the balance sheet of Mini Limited. All of these items have been given. Now, if you see, they have not given the balance sheet of Max Limited. Why they have not given? Because we have only acquired a particular part of their business. We have not acquired the full part of their business or the entire entity we have not acquired. We have acquired only one plant along with the labor force. Though it falls under the purview of Ind AS 103, though it falls within the purview of Ind AS 103, we do not need to combine the balance sheet. You just need to add those respective items in the respective places, right? So with this understanding, let us have a look at the solution. Ind AS 103 defines business as an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing goods and services to the customers, generating investment income and other income. In the given scenario, acquisition of power plant with labor force will be considered as integrated set of activity, and also explain that we have acquired the input and the process. Though it is non-operational, though it doesn't have an output, it still meets the definition of business acquisition. So who is the acquirer? Mini Equity Max Limited. Now, what is the purchase consideration? 51 million as given in the question. Fair value of the power plant 46.9. Now please remember, the fair value of the power plant 46.9, what we have considered is considered on this particular date. So why did we consider on that date? It is a provisional value. Subsequently we will update it. Okay. Fair value for the non-current assets given 11.1. Fair value of intangible asset, even if it is not recorded in the books of the equity, we will have to record it 5. Non-current liabilities given 32. So net assets, total asset minus liability, fair value 31. The purchase consideration is more than the net asset, and hence it results in goodwill. Now what is the initial journal entry? You will incorporate the PPE. Debit PPE 46.9, debit other non-current assets 11.1, debit fair value, debit intangible asset 5, credit non-current liabilities 32, debit goodwill 20, and credit the purchase consideration. If it is cash paid, we will write cash, or if it is a liability, we will say liability. Here we have paid through cash. So to bank, the amount of purchase consideration paid, which is 51 million. Okay. Now, balance sheet on the date of acquisition. Simply put, what you need to do is, see, the change will happen in property, plant and equipment. Whatever is the existing property, plant and equipment, what is the existing property, plant and equipment? 2158. Now to this 2158, you will add the value of the property, plant and equipment that you have acquired. That is the power plant that you have acquired, you will add it, right? So 2158, the property, plant and equipment valuation as on 1st of April, add power plant acquired 46.9, that is one addition. Then other non-current assets that you have acquired, you will add it to the other non-current assets. Cash 110 minus what you have paid 51. Then non-current liabilities plus liabilities that you have assumed 32. Apart from this, remaining all are line by line addition. Please remember, there will not be any non-current asset, non-controlling interest, and you will have goodwill on acquisition. So goodwill on acquisition is 20, that you will show separately, right? So wherever there are changes, that only you need to change, and nothing more than that. Now subsequently, what the question said was, subsequently they have done the valuation, and the fair value is given to be 54.9 million. So what has happened? From 46.9 it has become 54.9, means increase by how much? 46 to 54, that is 4 plus 4, 8 is the increase in value. Now when you increase the value of an asset, you have to reduce something else. What will you reduce in this case? We will reduce the value of goodwill. So whatever is the number, we will reduce to that extent of valuation of goodwill. And also remember, we would have charged depreciation, that will also have an impact in the financial statement. So let us see how do we present that. Mini Limited will retrospectively adjust the prior period information. Why will we retrospectively adjust? Now what we will do, we will retrospectively adjust the prior information that we have calculated, because see, we have taken 46.9, now it has become 54.9, means increase in 8 million. Property, plant and equipment value has gone up by 8 million. So you will increase the value by 8 million, but not only that, you will also need to look at the depreciation, because you will have to provide that extra depreciation. So actually if you see, what happens is, earlier you would have calculated depreciation considering 46.9 for 6 months. Now you have to consider 54.9 for 6 months, which means there is an increase in by 8 for how many months? 6 months. So what is the useful life? Useful life they have given is, I think, 40 years. They have a useful life of 40 years. So this 8 divided by 40 years into 1 by 2, this will be the depreciation impact. So 8 5s are 40, 1 by 10, that is 0.1 million. So PPE will be 8 minus 0.1, 7.9. The 7.9 is what? Increase in PPE. What will I decrease? I will reduce the goodwill by 8 million, because the valuation change has happened by 8 million. Earlier I thought it is 46.9, now I am saying 54.9, 8 million is the increase in value of asset. So my goodwill should come down by 8. So the net impact, if you see, goodwill reduced by 8 million, PPE increased by 7.9 million, and your depreciation expense you will increase by 0.1 million. That is what you will have to do in the third part of the question. Okay. Now coming to the last part, determine whether any adjustment is required in case of valuation received subsequent to acquisition. If yes, pass the necessary journal entries. Now what happened? Initially when we acquired, we said valuation is 46.9. Now this has become 54.9. Now what happens because of this? My PPE valuation, it increases by 8 million. My PPE valuation increases by 8 million. Now whenever there is an increase, and this has to be done retrospectively, it increases by 8 million. my asset has increased. If my asset has increased, I should reduce something else. What will I reduce? My goodwill will go down by 8 million. My goodwill will go down by 8 million. So this is one impact. So this will be done retrospectively. Now not only that, on this difference there has to be a depreciation impact also, because depreciation I would have calculated based on 46.9, now it is 54.9. So extra depreciation will be 8 million divided by life is 40 years into 1 by 2. So this becomes 0.1. So one entry is PPE debit 8, goodwill 8. Second entry is depreciation 0.1, provision for depreciation or accumulated depreciation 0.1. Very simple, nothing more than that is needed. So this is how you will look at, or this is how you will solve this type of question. A very good question, and can be tested if at all in the examination. Right, now moving to the second question. The second question is based on Ind AS 21. This is your foreign currency. If you want to watch Ind AS 21, the full lecture, the animated full lecture with all the explanations, it is available for free on our YouTube channel. You can make use of that. Infotech Global Limited, a standalone entity, has a functional currency of USD. So functional currency is USD and presentation currency is INR. Okay. So USD to INR. The following is the draft financial statement prepared in accordance with functional currency. So USD balance sheet has been given, USD PNL is also given. Now we have to translate these to INR. When you are translating these to INR, please understand all the assets and liabilities you will translate at the closing rate only. All the assets and liabilities will be at closing rate except equity. Equity is of course not a liability. Equity will be done using historical rate. Now they have also given statement of PNL, revenue, cost of sales and all of this, and profit for the year is given. Extract from statement of changes in equity, retain earnings in the beginning of the year 18,000, profit for the year 14,500, this number, dividends 3,000, we have to say when it is paid, retain earnings at the end of the year 29,500. Now this 29,500 you can see here. Now when it is the equity component, what you have to do is you have to take the opening INR, what is the profit, what is the dividend, and what will be the closing INR based on the INR numbers. Share capital was issued when the exchange rate was 70. So share capital, when you have to convert, you will say 50,000 into 70. Simple. Then at 31st March, cumulative gain of 4,92,000 has been recognized in the foreign exchange reserve, which is due to translation of the entity's financial statements into INR in the previous year. So here, as on 31st March of year 2, previous year, the number of what? The number of foreign exchange reserve, means whatever is the difference that arises because of translation, that you accumulate in the foreign currency translation reserve, that foreign exchange reserve is how much? 492. This is the opening balance. Entity paid a dividend of 3,000 when the rate was 73.5. So this rate, this you will multiply with 73.5 and get to the answer, get to the outflow. Then profit for the year 1-2 of USD 8,000 was translated at 572, that's for the previous period. For the current period, 14,500 translated in INR at 1072,985. So translated numbers of PNL are already given. For the sake of simplicity, items of income and expenses are translated at weighted average monthly rate, and there has been no significant exchange rate fluctuations during the entire year, and the business is not cyclical in nature. Relevant exchange rates on 31st March is 72, 73 or year 2. 31st March year 3 is 75. Prepare financial statement of Infotech Global translated from functional currency to presentation currency, that is INR. Right. Now here this number is already translated and given. They have not given us monthly weighted average rate. So this we cannot translate. This number is already translated and given to us. So what we need to prepare? Basically the balance sheet, and we need to prepare the statement of changes in equity and also the reconciliation of reserves, right? So let us see how do we present the answer on this. All the assets and liabilities are translated at closing exchange rate, which is USD 1 is equal to 73 on 31st of March of year 2 and USD 1 at 75 on 31st March of year 3. Historical rate is 70, that is already given, right? Now opening retained earnings. Now opening retained earnings, if you come back to the question, opening retained earnings on 1st of April is 4 lakhs. To this 4 lakhs, we will add this 5,72,000, we will get the closing retained earnings. So 4 lakhs plus 5,72,000, 9,72,000 is the closing retained earnings. Then to the 9,72,000, what we will do is, we will add the profit for the year 1070 to 985 minus the dividend. So plus profit minus dividend, we will get the closing retained earnings. Where do we take this retained earnings? We will take it to the balance sheet. So please remember, retained earnings don't multiply with the rate and convert. For retained earnings, you take the opening balance in INR, add the profit in INR, and what is the dividend in INR, and then get the closing balance, right? Now in the balance sheet, if you see, we have, all these numbers, it's a straight multiplication, property, plant and equipment, trade receivables, inventory, cash, all of them at the closing rate 75 and 73. Then share capital historical rate 70. This is where you have to keep a note of. Then retained earnings, as we have calculated here, 1824 and 972. Right. Then foreign exchange reserve, previous period number is given to us as 492. That is already given. If you see the question, on 31st March, cumulative gain was already there. So, this is already given, that will take as it is. Whereas, for the current period, this number is the balancing figure. Now, this is one chapter where even if the balance sheet doesn't tally, we will not get to know, because the translation reserve is a balancing figure. So, whatever is the translation reserve, the difference between the assets and liabilities, you will plug in here, and you have the total equity. Then trade payables, loan, we convert them, then you get total liabilities and equity. Once you plot all of the items, this number is the balancing figure. This number is the balancing figure in your entire financial statement. Now, 492 was the opening balance, 638 is the closing balance that you will present in the statement of changes in equity. Very, very simple question. Just you need to apply the fundamental concept and solve the question. Let us move on to the next one. Entity A owns all the share capital of Entity B and controls Entity B. On 1st of April of year 2, Entity A acquired a building from Entity B for 600 lakhs that the group plans to use as its new head office. So, they have acquired PPE. Entity B had purchased the building from a third party on 1st of April of year 1 for 525 lakhs. So, you have A, you have B, B has sold to A. At the time, the building was assessed to have a useful life of 21 years and a residual value of nil. On 1st of April of year 2, the carrying amount of the building was 500 lakhs. So, depreciated amount is already given. You don't need to calculate that again. In entities B's individual financial statement, the estimated remaining useful life of the building measured from 1st of April year 2 is 20 years. So, 21 has become 20, 1 year has lapsed. The residual value of the building is still nil. The method of depreciation is straight line. Pass necessary journal entries for recording the above transaction in the books of Entity B, Entity A and the group's general ledger. Very, very simple question. Here what we need to understand is, as far as Entity A is concerned, it is acquiring a building. So, in the standalone financial statement, what will it say? It will say that 600 lakhs is the purchase. So, in A's financial statement, you will say PPE purchased at 600 lakhs. Useful life of 20 years. When did they buy? They purchased on 1st of April of year 2 and they have not said till which date. Above transaction only 600. If at all you need to calculate depreciation, depreciation will be divided by 20, you get 30, carrying amount will be 570. Okay. For Entity B, what is the carrying amount? 500, sale value 600, 600 minus 500, 100 will be the gain. Now, in the group's financial ledger, will we recognize gain? We will not recognize gain. So, this gain will not be recognized and you will continue to charge depreciation using the original cost. So, 525 divided by 21, you get 25. The depreciation will be 25 and depreciation will not be 30. So, in the group's financial statement, you will reduce, in the group's financial statement, you will reduce the depreciation by 5. You will reduce the carrying amount here is 570 if at all you have charged depreciation, or 600 you will make it 500. So, you will show it at the carrying amount of B only. You will not show, because it is an intra-group transaction. Within the group, they have just sold from A to B, A has purchased from B. Within the group, you will not recognize the value changes. So, whatever is the original cost will be continued to be shown as the cost of PPE. Depreciation will also be based on the original cost only. On 1st of April of year 1, they are purchased at 525. On 31st March, depreciation for the first year 25. On 1st of April of year 2, 600 is the amount received, 500 is the carrying amount and 100 is the gain part. Okay. So, they have asked actually 1st of April of year 1 and 31st of year 1 2 entries itself. For A, 1st of April year 2, 600, depreciation 30, 30. That is what we had calculated, right? Here we had calculated this depreciation of 30. Then profit on sale of building 100 we have seen. Then in the group's book what will happen? In the group's book we will have to reduce the profit on sale of building, we have to eliminate it. So profit on sale of building that has been recognized in the standalone financial statements of the subsidiary, that will be eliminated, and you will also reduce the value of the building by 100, and you will reverse the depreciation. You will increase the value of the building by 5 and you will reduce the depreciation by 5, because depreciation has to be charged based on the original cost only. Let's have a look at the next one, which is on Ind AS 20, question number 5. Question number 4, because it is a complicated question, I would provide a detailed solution, because there are new things which have been introduced. It's very elaborate. A simple discussion may not help you, understand that. So what I'll do is I'll prepare a detailed solution of that separately, and I will, share that on the YouTube link. Now coming to question number 5 on Ind AS 20, an entity opens a new factory and receives at the beginning of the year a government grant of 15,000 in respect of capital equipment costing rupees 1 lakh. So 15,000 in respect of 1 lakh. It depreciates all plant and machinery at 20% per annum using SLM basis. Assume that there is reasonable assurance that the condition attached to the grant will be fulfilled. For year 1, pass the necessary journal entries and show the presentation of the effect of this grant in both the balance sheet and statement of P&L under both methods permitted under paragraph 24 of Ind AS 20. See, I don't actually recommend remembering paragraph numbers. It basically says both the methods. Now, what are two methods? One method is reduce it from the cost of the asset. Second method is set up a deferred grant, right? So, first one is 15,000. First method, 1 lakh minus 15,000. Your cost itself is 85,000, and this 85,000 at 20% per annum into 20%, you will charge the depreciation, which is 17,000. Straightforward, right? Second method is set up a deferred grant account. Now, when I set up a deferred grant account, what I do is I basically take the entire grant of 15,000 into something called as a deferred grant account, right? And from this 15,000, periodically, systematically, on a straight line basis, I will transfer to the income statement. Depreciation will be charged on 1 lakh only. Now, 15,000, how do I do it? Here we are saying 20% per annum. So, if I am charging depreciation at 20% per annum, from this account also at 20% per annum, that is 3,000, I will transfer to the income statement. Very simple. So, when you set up a deferred income account, bank account debit to deferred grant account, right, 15,000, 15,000, then 3,000 government grant to deferred income account and depreciation to accumulated depreciation using 1 lakh as the gross amount. Then when it comes to the, so what have they said? They have said for year 1 to pass the entries, right. So, I think they have passed the entries for every year, that is not needed. Now, in the first method, what do? We set up a deferred government grant account. So, bank account to deferred government grant 15,000, then you transfer 3,000 government deferred grant account or deferred government grant income account, whatever the nomenclature you use, to the P&L. Directly you can transfer it. What they have done is they have passed one more entry. You can directly pass it or say that to government grant income account or P&L head. That should be sufficient. Then depreciation 20,000. How 20,000? 1 lakh into 20% to accumulated depreciation, and that depreciation should be transferred to P&L. Now, how will we present it? In the income statement, government grant 3,000, expenses depreciation 20,000. Net effect need not be calculated. Okay. Now, coming to balance sheet presentation, plant and machinery will be shown at the gross value of 1 lakh, accumulated depreciation 20,000, net amount 80,000, and government grant, you have split that between the current liabilities and non-current liabilities. Current liabilities which will be utilized in the next period, that is next 12 months, which is 3,000, and the balance 9,000 non-current. See, totally we received 15,000 of grant. Out of this 15,000, 3,000 is transferred to P&L. We are left with 12,000 of grant. This is the liability. Out of this 12,000, 3,000 is current and your 9,000 is non-current. Okay. Now, in the second method, directly you reduce the government grant that you have received from the plant and machinery. So, you will reduce that from plant and machinery. 1 lakh minus 15,000, 85,000 becomes the cost of plant and machinery, and 85,000 into 20% is the depreciation 17,000. That depreciation you transfer to P&L. In the P&L statement, you will have only depreciation expense 17,000. In the balance sheet, plant and machinery, the cost 85,000 minus depreciation 17,000, carrying amount is 68,000. No deferred grant account as a liability, right? Simple and straightforward. Generally, don't expect such kind of direct questions in the examination. Right, now moving on. In days 8. In its financial statement for the year ended 31st March of year 2, Y Limited reported 73,500 revenue, 53,500 cost of sales, 6,000 income tax expense, 20,000 retained earnings at 1st of April and 34,000 retained earnings on 31st of March. In year 2, year 3, so this is year 2, subsequent period, after the financial statements were approved for issued, means after the financial statements have been issued or approved for issued, which means the event is no longer an adjusting event. They discovered that some products sold in year 1, year 2 were incorrectly included in inventories on 31st March of year 2 at their cost of 6,500. Now this is an error. Here we are not talking about adjusting or non-adjusting event. This is an error. What is the error? We have included the inventory. We have included some sold items in inventory, means inventory has been overstated. In year 2, year 3, Y Limited changed its accounting policy for the measurement of investment in associate after initial recognition from cost model to fair value model as per Ind AS 109. So, Ind AS 8 plus 109 combined. It acquired its only investment in an associate for 3,000 many years ago. The associate equity is not traded on a security exchange, that is, a published price quotation is not available. The fair value of the investment was determined reliably using an appropriate equity valuation model on 31st March of year 3 at 25,000, previous period 20,000 and end of first period, that is end of 31st March of year 1 or as on 31st March of year 1, 18,000. At 31st March of year 3, as a result of usage of improved lubricants, Y Limited reassessed the useful life of machine A from 4 years to 7 years. Machine A is depreciated on straight line method to a nil residual value. It was acquired for 6,000 on 1st of April of year 0. Inventories of the type manufactured by machine A were immaterial at the end of each reporting period. Now, why they have said this is, see here, what has happened? They have revised the machine A's life. Now, when you revise the machine's life, the depreciation of that machine will have an impact on the inventory valuation. But here what they are saying is inventory is immaterial. So, basically what they are saying is don't consider that change of depreciation will have an impact on the inventory, right. Then Y Limited accounting records for the year ended 31st March of year 3 before accounting for change in accounting policy and change in accounting estimates record 1,04,000 revenue, 86,500 cost of sales including 6,500 for the error in opening inventory and 1,500 depreciation for machine A and 5,250 income tax expense. Y Limited presents financial statements with 1 year of comparative information. So, what they will do is for 31st March of year 3, they have a comparative information on 31st of March of year 2 as well. Now, we will need to prepare up one more balance sheet on 1st of April of year 1 because of errors and because of changes in accounting policy. For simplicity, the tax effect of all items of income and expense should be assumed to be 30%. Draft and extract showing how the correction of the prior period error, change in accounting policy, change in accounting estimate could be presented in the statement of P&L, statement of changes in equity and disclosed in the notes of Y Limited for the year ended 31st March of year 3. Right. Very long questions. Sometimes they may give this kind of lengthy questions in the examination. You have to patiently understand each aspect and give an appropriate response. So, now let us look at each of the items. First, in year 2, year 3, after 2001-2 financial statements were approved for issue, Y Limited discovered that some products sold in year 1, year 2 were incorrectly included in inventories at 31st March of year 2 at their cost of 6,500. Now, what is the impact of this? Let us see. On 31st March of year 2 financial statements, your COGS is lower by 6,500. Why is it lower? It is lower because you have increased the value of inventory, right? And this while correcting what they have done is, here if you see, they have included this in cost of sales in 31st March of year 3. So, 31st of March of year 3, whatever is the cost of sales, they have added 6,500. Now, as far as Ind AS 8 is concerned, prior period errors have to be retrospectively adjusted, right? Now, here it is not a case of impracticability. So, you will have to go back and adjust it retrospectively. Now, this 6,500 of cost of sales, you have to reduce, you have to add it. Because you have reduced, you have to add it or you have to increase. You will have to increase 6,500 in which period? 31st March of year 2, and this incorrectly what is done, you have to bring it down, you have to subtract 6,500. So, 31st March of year 2, if you see the financial statement, they have said cost of sales is 53,500. Actually, cost of sales is 53,500 plus 6,500. So your cost of sales will be 53,500 plus 6,500. That will be 53 plus 6, 59, 60,000. That is the first thing. Second, this cost of sales 86,500, what you will do is 86,500 minus 6,500, you will get 80,000. Yes, so that is the first thing. Then the next thing is change in accounting policy for the measurement of investment in associate after initial recognition from cost model to fair value. Change in accounting policy, again retrospective application, right? So what they have said, they have moved from cost to fair value. Right, what is the cost? Have they given the cost? Now they have given the cost of how much? Cost is 3,000 here. Cost is 3,000. Fair value at the end of year 1, 18,000. That is, if you write it here, 1st of April of year 1, valuation is 18,000. 31st of March of year 2, the valuation is 20,000. Means there is a 2,000 increase. So this will be recorded as a gain in the P&L. Why? Because they have taken it as fair value through P&L. Then that's what they have written, right? Fair value model as per Ind AS 109, that has to be fair value through P&L because you do not have fair value through other comprehensive income option for investment in associates. That is the second thing. So this 2,000 will be gain in P&L for 31st March of year 2, and for 31st March of year 3, what is the gain in P&L? It has become, it is 25,000 from 20,000. So 5,000 is gain in P&L. So 2,000 here, 2,000 here and 5,000 here, which is the gain in P&L. Third, as a result of improved lubricants, Y Limited reassessed the useful life of machine from 4 years to 7 years. Machine is depreciated on SLM basis to nil residual value. It was acquired at 6,000 on 1st of April of year 0. Now this is a change in accounting estimate. First one was an error, second one is a change in policy, third one is an estimate. Change in estimates are accounted for prospectively. When did they change? At 31st March of year 3. Means in the current financial year, they have reassessed the estimated useful life. Now, from year 0, that is for the year ending 31st March of year 1, year 2, 2 years has been completed, right? 31st March of year 1 and 31st of March of year 2. How many years have we used the machine so far? At the beginning of the year, 2 years. What was the cost? 6,000. So 6,000 divided by useful life is 4 years. Earlier it was 4 years. Now it will be 7 years into 2. So the depreciation charged was 3,000. Depreciation charge was 3,000. So opening balance on 1st of April of year 2 is how much? 3,000. Now on this 3,000, we will charge depreciation for remaining how many years? 5 years, because it says 7 years, which means 5 years are left. So 3,000 divided by 5, the depreciation will be 600. Now tell me one thing, is this an increase in depreciation or is this a reduction in depreciation? This is a reduction in depreciation. Reduction in depreciation means your cost of sales will also go down. Now they have given for the current period cost of sales to be 80,000. Cost of sales to be 80,000. From here you have to further, we have considered 86,500 minus 6,500. 86,500 is the total cost. From that 6,500 is an error, we have corrected. Now we have 80,000. Depreciation charged is 1,500. Whereas, how much should the depreciation be now? 600. We have to reduce from 1,500 to 600, means 900 extra depreciation was charged. So, 80,000 minus 900 when you do, you get 79,100, which is the revised cost of sales after making the adjustments, right? So, these are the adjustments as far as the cost of sales are concerned. So, let us see how do we present the P&L, the first part of it that we have completed. Revenue given as it is 1,04,000 and 73,500. Cost of sales. Now current period cost of sales as we calculated 86,500 minus 6,500 minus 900, we get 79,100. So 79,100 is the cost of sales. Previous period cost of sales we calculated to be 60,000. So 60,000 is what is being considered here. So you get the gross profit. Then after that, other income of 5,000 and 2,000 here. This comes from what? This comes from your change in accounting policy. Now, we have profit before tax of 29,900 and 15,500. Now, what is the next thing to be done? Taxation impact. Now, if you look back at the question says that for simplicity purpose, the tax effect of all items should be assumed to be 30% of the gross amount. So, they have not said us, defer tax, this tax, that tax breakup, 30% is the taxation impact, right? Now, how much tax did we report initially? Initially, we have reported 6,000 of tax. 6,000 of tax. Now, what are the changes that has happened? One change is our 6,500 of your error. Because of this error, my profit will go up or come down. My profit in the previous period, that is this particular period which is reported 31st March of year 2, for 31st March of year 2, my profit will go down. Then I have a gain. We have calculated a gain of how much? 2,000. So, gain of 2,000, this will increase my income. So, net is minus 4,500. What is the impact? 30% is the impact. So, 4,500 into 30% is 1350. So, my tax should go down by 1350. How much did we report? 6,000 minus 1350 is 4,650. 4,650 is the impact of income, net income tax that needs to be reported. Now, for the current period, 5250 is the income tax expense. 5250 is the income tax expense. Now, what are the changes that has happened? 6,500 increase in profit because of correction of error, because we had incorrectly taken 6,500 in the current period. Then 900 depreciation impact, improve or increase in profit. Then fair valuation changes 5,000. So, 6 plus 5, 11, 12,400 of this 30% impact. So, 12,400 into 30%, when we do, we get 3720 plus 5250, when we do, we get 8970. So, 8970 is the taxation impact. 5250 plus 3720, 8970 is the taxation impact. Slightly comprehensive and a very good question for practice purpose, right? Now, that is as far as the P&L is concerned. Moving on to statement of changes in equity, they want us to, present the restated changes, statement of changes in equity. Now, how do we do that? Now, here, if you see what is the opening balance, they have given the opening balance in retained earnings as 20,000 as on 1st of April of year 1 and 34,000 on 31st March of year 2. So, previously we have reported these numbers. Now, this has to be restated. Why restated? Because there is a change in accounting policy. Because of accounting policy, whatever was there on 1st of April of year 1, it has changed. What has changed? Here if you see, on 1st of April of year 1, the value of investment is 18,000. This against a cost of 3,000, there is a gain of 15,000. This gain has an impact of tax at 30%, which is 4,500. So, the net gain is 10,500. So, whatever is my opening retained earning balance as on 1st of April of year 1, that will increase by 10,500 because of accounting policy change. That is the first thing. Second, as on 31st of March of year 2, as on 31st of March of year 2, the balance is 34,000. Here also, because of change in accounting policy, how much will my retained earnings increase? My retained earnings will increase by 3,000 is the cost and 20,000 is the valuation. So, 17,000 is the gain. On this, tax impact is 5,100. So, it will increase by 17,000 minus 5,100, 11,900. 11,900. So, whatever is the retained earnings, opening balance 20,000, that is as on 1st of April of year 1, we will add the cumulative impact as on 1st of April of year 1, that is 10,500. Subsequently, in the second year, 34,000, what is the impact of change in accounting policy? 11,900, right? That is what we will add. Second, prior period errors also have to be retrospectively corrected. Now, if you see, the prior period pertains to 31st March of year 2 balance sheet. Right. Now, 31st March of year 2 means in this opening balance, we have to adjust it. Now, what is the impact? Impact is 6,500 into 30% if you reduce, 6,500 into 70% if we do, we get 4,550. 4550. So if I do 70%, I get 4550. So why 70%? 6500 is the gross impact, 70% is the net impact. So if I reduce the 70%, I get 4550. So 4550 is what I will adjust here. Sir, will we not adjust in year 3, year 4? No, because in year 3, year 4, we have already corrected in the same period, right? So that is the first thing. Then profit for the year 2930 and 10850. So whatever you have calculated here, 2930 and 10850, that will be considered, and you will get the closing balance at the end of the year. Now this end of the year here means as on 31st of March of year 3 and 31st of March of year 2. And then we will also need to give the notes. Now what kind of notes? It need not be so much elaborate in the examination, you will not have so much of time, but still you will have to explain. Now coming to notes on financial statements, first for the change in accounting policy, why did we change the accounting policy? Due to using lubricants. What is the impact of change in accounting policy? Life has increased from 4 years to 7 years. Then what is the impact in terms of value? 900 depreciation will be reduced in the current period also, in the subsequent period also. What is the after tax impact? After tax impact is 630 because 30% you will take off or you will have to pay extra in taxation. Then what will be the impact subsequent to year 4? See, initially we had useful life of 4 years. So in the first 4 years, we thought we will charge depreciation of 1500 each. Now we will revise to 600 in the year 2, year 3 and year 3, year 4. Subsequent period, there was no depreciation. Now we will have a charge of depreciation of 600. Now a lot of students may be having a doubt, sir, will we be able to remember and be able to write so many things? Actually not needed in so much of detail because this is an ideal accounting policy presentation, right? So you can give as much of information as you can to the extent you remember in the examination. Then on correction of prior period error, what has been sold, what has been included in inventory, because of that what was done as correction and what is the impact on cost of sales and after tax profit. So basically it will reduce the profit in the year ended 31st March of year 2 on a net basis of 4550. Then change in accounting policy, they have changed in accounting policy to move from cost model to fair value model for investment in associate. Because of this accounting policy changes, there is a retrospective restatement and retrospective application of the changes in fair value, and the impact in the opening balance is how much? 15,000, after tax 10,500. In the current period, the impact is 10,900 and income has been recognized accordingly. So that has to be given. So here if you see 10,500 increase in the opening retained earnings, then 11,900 increase on the retained earnings on 31st March of year 2, and in the current period the net impact of profit being 3,500, and in the previous period the impact being 2,000, net of tax 1,400. In the examination, if such kind of questions come, write to the extent possible that you can present it, okay. This is an idealistic scenario, as I told you. Such kind of detailed disclosures are not generally expected in the examination. Even if you are able to portray that yes, opening balance increased by so much of amount, then for example, in this case 10,500, then in the current period the impact is 11,900. So even if you are able to demonstrate that 10,500 was increase in the opening retained earnings as on 1st of April of year 1 or 31st March of year 1, and 11,900 in the subsequent period, impact in the P&L 3,500 in the current period and 1,400 in the previous period, all after taxation, that will be more than sufficient in the examination. Working notes for all the calculations we have done, I have done a rough scribble, you can go through it, and I know we have covered each and every item in detail in this aspect. 12. On 1st of April, an entity paying tax at 30% acquired a non-tax deductible office building for 1 lakh in circumstances in which Ind AS 12 prohibits the recognition of the deferred tax liability associated with the temporary difference of rupees 1 lakh. So, you have 1 lakh at which you have acquired the building. Now, the building is non-tax deductible, you will not get deduction for the tax purpose. The building is depreciated over 10 years at rupees 10,000 per year to a residual value of 0. So, this is the depreciation. The entity's financial year ends on 31st of March. On 1st of April of year 2, the carrying amount of the building is 90,000 and it's revalued upwards by 45,000 to its current market value of 135. There is no change to the estimated residual value of 0 or to the useful life of the building after the revaluation. Determine the carrying amount, depreciation for the year ended 31st March of year 3 and deferred tax thereafter till the useful life of the building. So, you have to calculate the deferred tax portion. Further, analyze the treatment and impact of deferred tax since 31st March year 3 till the useful life of the building. So, here the question is, you have acquired a building and now that building is non-tax deductible. Non-tax deductible means what? The tax base of the building would be 0. The tax base of the building would be 0. Now, when the tax base of the building is 0 and this 1 lakh is the carrying amount. So, carrying amount you have is 1 lakh and tax base is 0 on the date of acquisition, there is a difference of 1 lakh. But what the question says, in some circumstances in which Ind AS 12 prohibits the recognition of the deferred tax liability associated with the temporary difference of rupees 1 lakh. So, because of some reason you cannot recognize deferred tax liability on that 1 lakh. Subsequently, the building is revalued to 135. There is an upward revaluation of 45,000. Now, please understand, originally the building is at 1 lakh, tax base is 0. This is the carrying amount, this is the tax base. Then, after 1 year, building is 90,000, tax base is still 0. From 90,000, we revised it to 1,35,000, the tax base is still 0. Now, here there are differences. Now, their difference is 1 lakh. For this I cannot recognize. Here the difference is 90,000. For this also I can't recognize because the question says you cannot recognize deferred tax liability. There are some exceptions in Ind AS 12. Now, when I make it 1,35,000, the difference is 1,35,000. Out of this 1,35,000 of difference, this 90,000 for which I cannot recognize a deferred tax, whereas for the balance 45,000 which is a temporary difference, I can recognize deferred tax at the rate of 30%. So, like this you will calculate next year. Now, this 1,35,000, the useful life is how much? On 1st April you revalued, so the 9 years are left. So, 1,35,000 divided by 9 means depreciation is 15,000. So, now you will have 1,20,000 as the carrying amount, this is 0. Now, 1,20,000, the carrying the tax base is 0, there is a difference of 1,20,000. Now, on this entire 1,20,000, I cannot recognize deferred tax. I cannot recognize deferred tax. On what amount can I recognize deferred tax? This 1,20,000 comprises of 80,000 of original carrying amount, that is 1 lakh, 90, 80 and all of that. 45,000, 5,000 I would have charged extra depreciation, now I have a difference of 40,000. On this basis, you can recognize deferred tax, and like this you will continue to recognize deferred taxes. Another new question, not seen earlier. So, let us see how it is solved. Carrying amount 1 lakh, tax base 0, 1 lakh is the difference, 1 lakh is the unrecognized temporary difference. As you move ahead, in the second year, the difference comes to, after revaluation, the difference comes to 90,000, out of which 45,000 you can recognize temporary difference, which brings me a tax liability of 45,000 into 30%, 13,500. Like this 40, 35, 30, 25, you keep on reducing it till the end of the 10th year. Now, moving on. A company engaged in the provision of information technology products and services incurred following expenditure during the development phase. So, you can capitalize of its software product that is to be offered to its customer. The entity also purchases software from a third parties for incorporating into its end software product offered to its customer. So, they develop something in-house, they purchase something from outside. The company is in the process of launching it in the market for licensing to customers. The company also takes services of external professional software developers for such development purpose. Cost incurred in relation to the development of its software for the year ended 31st March year 2 is given below. So, their cost has been given. Purchase price of imported software, employment cost, note number 1, it says software was developed in 9 months ended 31st December of year 1 and was capable of operating in the manner intended by the entity. It was brought into use on 31st March of year 2. Now, please remember, you will capitalize till 31st December of year 1 and from this date only you will start charging amortization. The employment costs are for the period of 12 months. So, this employment cost is for 12 months, from this you will take only 9 months, that is 900. The employees were engaged in developing the software and related activities. Then testing cost 1800, other cost directly related to customization. Other costs directly related to development include an abnormal cost of 50,000 in respect of repairing the damage which resulted from a security breach. Abnormal losses will not consider. So, from this you will remove 50. Professional fees paid to external software developers, cost of training provided to staff to operate the asset, cost of advertising, administrative and general overheads. Now, this we have seen multiple times these type of questions. What is to be included, what is not to be included, and we need to calculate the software development cost and you have to give the reason for each element, right. Now, first The purchase price of software we will include because that is the material which is used in the generation of the intangible asset. Employment cost we will consider only 900 for the period for which employees have worked, we will not consider the entire 1200. Then testing cost 1800, the cost of testing is a directly attributable cost and we will include, it is a simple straightforward thing. Other cost out of 450 we will take only 400 because 50 is abnormal, we will exclude that. Professional fees paid for bringing the software to its working condition, definitely we will include it because that is again used in relation of that particular intangible asset. Cost of training provided to staff. Now expenditure on staff training for operating that asset cannot be capitalized because that does not add value to that particular asset. See, I create a software, now for that software I am training the employees and this training will continue to go on for again and again. Every time a new batch of employees come, I will train those employees. So should I capitalize that? I cannot capitalize that. Why? Because it is not necessary to bring the software in the condition or location as intended by the management. Training is to operate the software. For creation of software, training is not needed. Then cost of advertising, of course you will not include, and administrative and general overhead 825 you will not include, right, because they are not included or they are not considered to be a part of the cost of your intangible asset. Now Ind AS 109, on 1st April a bank provides an entity with a 4-year loan of 5,000 on normal market terms, including charging interest at a fixed rate of 8%. So 5,000 of loan, 8% of interest. Interest is payable at the end of each year. So 5,000 into 8%, 400 you will pay at the end of each year. The figure of 8% is the market rate for similar 4-year fixed interest loan with interest paid annually in arrears. Transaction cost of 100 is incurred in originating the loan, hence effective interest rate in this case is 8.612. So 5,000 and transaction cost of 100 is incurred. Fine. In year 1, year 2, the entity experienced financial difficulties and on 31st March of year 2, so when did we take 1st of April? On 31st March of year 2, the bank agreed to modify the terms of the loan. Under the new terms, the interest payment in year 2, year 3 and year 4, year 5 will be reduced from 8% to 5%. So they are taken a 4-year loan. Okay. The entity paid the bank a fee of 50 for paperwork relating to the modification. Analyze whether the modification of the loan terms constitutes an extinguishment of the original financial liability or not. Now here there is a modification. Now this is a case of modification. In modification, what do we need to check? What is our existing liability? We will calculate, we will figure out the amount of existing liability. What is the new liability? And what is the difference? Based on the difference, by applying the 10% threshold, we will decide whether there is a substantial modification or not. If there is a substantial modification, we will say existing liability is extinguished and we have a new liability in place. That is, the existing liability has been replaced by a new liability. Whereas, in other cases, we will say it is not a new liability, it is actually a modification. Now, here if you see, the loan amount that has been taken, 5,000. I will actually use an Excel to calculate that. Now, in this case, if you see, the loan is taken on 1st of April. So, from 1st of April, so year 1, year 2, then you have year 2, year 3, then you will have year 3, year 4, and then you will have year 4, year 5. Okay. Now, what is the opening balance? It says 5,000 of loan and 100 of processing charges. So, the net amount is 4,900. Interest at what rate? Interest at the rate of 8.612%. 0.612%. So, 4,900 into 8.612%. If you do, you get 421.988. And how much did we pay? 400 we paid. So, closing balance is opening plus interest minus paid closing balance is 4921. Then 4921 rate for interest 8.6, 423, 400 closing balance. Opening balance, interest rate paid, closing balance. Opening balance, interest paid, closing balance 4998. So actually you pay 5,400 and the closing balance becomes 0. Right? This is the original schedule. Now, when did the modification happen? The modification happened on 31st of March of year 2. So on 31st of March of year 2, that is this period 4921, when the balance is 4921, that is when the modification happened. Now, how many interest payments are left? It says that interest payment under the new terms for year 2-3 to year 4-5. So, remaining 3 years of term, the interest rate will be 5%. So what is the revised cash flow? Revised cash flow for year 3, year 4 will be 250. It says 5%, yeah, 5%, 250 and 5250, right? And the entity paid bank a fee of 50 rupees related to paperwork modification. So they have paid 50 for paperwork related to modification. Now, when did we pay the modification? We paid today. So on 31st of March of year 2, we paid 50 of modification. So what is the present value? Present value here is 1 factor, present value factor I should say. Then here it is 1 divided by 1.8612, 1.08612. Then this divided by 1.08612. Like this you can calculate the present value factor. So present value will be 50, 230, 211 and 4097. If you total it up, we get 4589.67. Now the closing balance here we have is 4921. The value of the new liability is 4589.67. 4589.67. Now 4589.67, and you compare with this, what is the difference? The difference is 4921 minus 4589.67, 332. 332 divided by 4921.91 is 6.75. So it is 6.75%. Hence, this is not a replacement. It is not an extinguishment. It is just a modification. So what you will do? You will consider the revised effective interest rate and you will calculate or you will do the accounting for the transaction, right? So this table you have already prepared. Then present value is 4921.91, that is the closing balance. 4921.99, that is the closing balance. Then the present value of cash flow under new term is 4587.25, 4589. So that is 4589, 4587, slight difference because of rounding off. Difference is only 6.8%, and hence since the difference between the discounted present value of cash flows under the new terms, including fees paid net of any fees received and discounted using the original effective interest rate, is less than 10% of the present value of remaining cash flows, this modification should not be considered a substantial modification of the terms. Hence, it should not be accounted as an extinguishment of the original financial liability. Very, very simple. Now, moving on to the next question in day 7. One of the subsidiaries of Buildwell submitted to Central Finance its summarized statement of P&L and balance sheet. Summarized P&L for the year: sales, cash cost of sales, depreciation, salaries, operating expense provision, non-recurring income, profit on sale of equipment, retained earnings and profit brought forward, dividends declared and paid during the year, P&L balance as on 31st of March. Balance sheet has been given. Okay, now original cost of equipment sold during the year is 720. Prepare a statement of cash flows for the year ended 31st March of year 3. Very, very simple. You just need to start from what is the P&L. So the profit for the year is how much? 840. This is the profit for the year. From there you should start. This is not the profit for the year. From there you should start. Exclude depreciation, which is a non-cash item. Provision for taxation, we can present it separately. Then you will see the movement in current assets, movement in inventories, trade receivables and advances. This you will do the adjustment for. Then share capital, there is a movement. So the thing is, this is year 2 and this is year 3. Okay. Generally, we show year 3 first and year 2 next. This I have told in the class also. But here they have given year 2 here and year 3 here. So be extra careful. So the movement is from here to here. Okay. For change in assets, as we said, you take opening minus closing. And for change in liabilities, you take closing minus opening. For working capital changes, that will help you solve it. There is nothing specific here or complicated here to be discussed. And you can see net profit before taxes and extraordinary items. Actually, there is nothing called extraordinary item that you present in the statement as a statement of cash flows as per Ind AS, but nonetheless. So now here if you see, if you start from profit 840 minus 120, you will get 720. Why minus 120? Because this is pertaining to investment activities. Then you have 880, you will add this 880, you get 16 lakhs, right? So same thing. 16 lakhs what you can see here, 16 lakhs. Then depreciation you add back, operating profit before working capital changes. Then you have increase in inventories, trade receivables, changes in advances, trade payables, decrease in trade payables, any other outstanding expenses. All of this is from the P&L and the balance sheet. All of this is from the balance sheet. Then taxes paid. Now for taxes paid, here you can see income tax payable 132 and 120. Then when it comes to income tax, opening balance is 120, 123. Then for the period expense, for the period expense is 880. Closing balance is 132, 123. So this is credit side, this is the debit side. If you do 880 plus 120 minus 132, you get 868. So 868 is the taxes paid. So 868 is the taxes paid, simple to derive. Then purchase of land. So if you come back to the balance sheet, you would see movement in land. So 480 became 960, there is a purchase. Building also there is a change. For buildings, you will have to prepare again the building account. You can prepare the building account using the gross amount. From that, whatever has been sold, you transfer it to asset for disposal account, and whatever is the balancing figure is the addition to the building. So very simple, nothing complicated here. So let's move to the next one on Ind AS 105. Company X has identified one of its division disposal group to be sold to a prospective buyer, and the board has approved the plan to sell the division on 30th of September. The sale is expected to complete after 1 year, but it is still qualifies to be held for sale under Appendix B of Ind AS 105. Cost to sell the division is estimated to be 10 crores to be incurred in March year 3. The fair value of the division is 400 crores on 30th of September of year 1 and 31st March of year 2. So fair value is 400 crores. Carrying value is 500 crores. So we have to take it below lower of fair value less cost to sell and the carrying amount. How will such a division disposal group be measured under Ind AS 105 on the following reporting dates? On 30th September of year 1 and on 31st March of year 2. Consider the discounting factor at 10%, 0.909, and for 1.5 years to be 0.867. Now, here very simple, you will show it lower of carrying amount and fair value less cost to sell. Fair value is also given. Cost to sell, how much is the cost to sell? Cost to sell is 10 crores. Now, whenever the cost to sell is beyond 1 year, we have to discount it. So, when you value on 30th of September, we need discounting factor of 1.5 years because we are selling it after 1.5 years. Here, we will need discounting factor for 1 year because we are selling it after 1 year. So, 31st March to 31st March of next year is within 1 year. Here, the question says that it is anticipated to be sold in by March year 3. Okay, so that is what is happening. So you can still say it is beyond 1 year, and because it is beyond 1 year, you will consider the discounting factor. Another assumption is if you sell within 1 year, then you can do it without discounting factor as well. So cost to sell is 10 crores into 0.867 here, so it will be 8.67. and here it will be 9.09. So from this fair value, you will reduce this, and that will be the carrying amount of the non-current asset which is held for sale. So on 30th of September, 400 minus 8.67, you have 391.33, and fair value 400 minus 9.09, it will be 390.01, right. Now what is about the increase? That increase is nothing but the finance cost, finance component that will be recognized in P&L. Very simple question. Ind AS 2, A Limited began its operation in year 1 to, in 1 to it incurred the following expenditure on purchasing raw materials. Purchase price 30,000, import duty and other non-refundable purchase taxes 8,000, so this will be added because it is non-refundable. Refundable purchase taxes you will not consider. Freight cost for bringing the goods from supplier to factory store 3,000 you will include. Then cost of unloading the materials into the storeroom of raw materials 20, yes, included. Packaging 2,000. Now this packaging is for what? Packaging is towards raw material. So raw material packaging, we will include it in the cost of inventory. Then on 31st March of year 2, A Limited received 530 of volume rebate from a supplier for purchasing more than 15,000 from the supplier during the year. Now this is related to purchases. This discount will be removed or reduced from the cost of inventory. Sir, is this not a cash discount? This is not a cash discount. This is discount based on purchases, and hence this will be reduced. Following costs were incurred in the production run: salary of machine workers included, factory supervisor included, depreciation included, consumables used in production process included, depreciation of vehicle used to transport the goods So the vehicle which is transporting the goods, this cost will be included. Factory electricity uses included, rental included of factory, depreciation of entities vehicle used by the factory supervisor. Now whatever factory supervisor, whatever we are paying to the factory supervisor, that also will be included. Then A Limited incur the following administrative expenses. Depreciation of administrative building you will not include unless they have given some other information. Depreciation and maintenance of vehicle used by administrative staff and salaries of the administrative personnel, all of this you do not include. Of the administrative expenses, 20% is attributable to administering the factory. Okay, so out of these three costs, 20% is attributable to administering or running the factory. So 20% of this cost will be included. Remaining expenses are attributable in equal proportion to sales and other non-production expenses. In year 1 to A Limited incur the following selling expense. Advertising cost you will not include. Depreciation and maintenance of vehicles used by sales staff not included. Salaries of the administrative personnel not included. Past journal entries to record the cost of inventory in the books of A Limited. So surprisingly they are asking journal entries. This you would learn as a part of costing, and also when we do accounting standard and Ind AS also. Now first we have to calculate, or we have already seen what is to be included, what is not to be included. Now when they say journal entry, what is to be considered? I have told in the class also, when you purchase a material, you don't say purchases to supplier, actually it is inventory to supplier. Now here if you have already paid the amount, so what you will say, inventory debit, the total of all of this amount to supplier or to cash. Then all this cost which have been incurred, this will also be debited to inventory and credited to either cash or the respective expense head. For example, if you say depreciation 400, that you will credit to depreciation, because let us say depreciation expense is 1000, you will say debit depreciation 1000 and accumulated depreciation 1000. Now what you will do, from this you will say debit inventory 400, credit depreciation 400, right? So like that you will pass the entries. Let us see the solution. Inventory to cash or bank we have paid. Then inventory 11240 to cost of direct labor, to property plant and equipment 600. Now you can you actually do not credit to property plant and equipment. What you will do is you will credit it to depreciation account, or accumulated you will credit it to depreciation account, or other way what you can do is debit depreciation expense 600, debit inventory 400, credit accumulated depreciation 1000. This can be done. Still you can credit to property plant and equipment if you are following the net basis, right? Then raw material delivery vehicle, that you will add, cost of electricity you will add, then depreciation on factory supervisor, then factory management salary, factory rental, then administrative salaries attributable to the factory as given in the question. So the question has mentioned that salaries of the personnel is 3050, of that 20% is attributable, so that you will credit to cash or bank, or you can say salary payable, or you can credit to salary also. If the salary account has taken the full hit of 3050, 610 can be credited to that account. Then the depreciation attributable to the building and the vehicles. Then consumables. So consumables have been consumed, so that also gets added to inventory. 200 of consumables have been consumed, that gets added to inventory, right? So that is how you will calculate you will pass the entry for inventory. So that is how you will pass the journal entry for inventory. Actually speaking, in real life such kind of entries would not be passed. Okay, so system will calculate and directly knock it off from the the control accounts that are created, right? So surprising, institute is asking these kind of questions as well. Then Ind AS 14, Ind AS 16, a combined question. 40 deals with investment property, 16 deals with property plant and equipment. Besides manufacturing plant, A Limited has various other assets not used for operational activities, example freehold land, township in different location. A Limited also has some land which are kept vacant as per the government regulations, which require that a specified area around the plant should be kept vacant. The details of these assets are: A Limited office building, registered office. A Limited registered office is in Delhi. is a 15-story building of which only 3 floors are occupied by A Limited, whereas remaining floors are given on rent to other companies. These agreements are usually for a period of 3 years. According to A Limited, such excess office space will continue to be let out and leased to external parties and have no plans to occupy it at least in the near future. So here 3 floors owner occupied, 12 floors investment property. Then second one, flats in township located in location 1. As regards to township in location 1, there are approximately 2000 flats in the said township. It was built primarily for A Limited's employees, hence approximately 80% of the flats are allotted to its employees. So this is clearly a case of property, plant and equipment. The remaining flats are either kept vacant or given on rent to other external parties. A lease agreement is signed between A Limited and an individual party for every 12 months for 1st April to 31st March. Lease entered is a cancelable lease. Also, besides monthly rent, additional charges are levied by A Limited on account of electricity, water, cable connection, etc. Now, and as per A Limited, there is no intention for selling such excess flats or allotting it to its employees. Right now here 80% is of course PPE, that is very clear. Whereas the balance 20%, they are giving it out on rent. So most likely it will qualify as an investment property. Again, you have to see the intention, okay. But they clearly said that there is no intention of selling such excess flats or allotting it to its employees. Means they will not give it to its employees. They will not sell that flat also, but they are still giving it out on rent. So that can qualify as investment property as far as the remaining 20% is concerned. Now these charges which are collected, normally what happens is, if it is a business of managing property, okay, it is business of managing property, you provide some additional services, in that case we may consider or we need to evaluate whether it is a business or we need to evaluate whether that itself is a business or not. Now, but here collection of electricity, water and cable connection, these are smaller amounts, so this will not be definitely a business, okay, that is, those are just ancillary small charges. So flats let out PPE, other flats most likely investment property based on the given statement. Then there are 1000 flats in location 2 of township, this is location 2, 400 are given to employees for their own accommodation, PPE, 350 are given on rent to central government and state government for accommodation of their employees. Average lease period is 12 months with cancelable clause. 250 flats are kept vacant. So this is investment property. Again, you are giving it out on rent. 250 are vacant. Now here you need to see what is the purpose. And based on the purpose, you will classify whether it is a PPE or investment property. Hostel. 60 rooms in the hostel have been let out to G Limited to give accommodation to their personnel. Lease agreement is prepared for every 11 months and renewed thereafter. Besides the monthly rent amount, some charges are levied towards water, electricity and other amenities, cable connection, etc. Again, here also you are giving it out on rent to others, so it is an investment property. Now, if you run hostel as a business, like apart from giving it out on rent, you provide food, you provide other facilities, laundry services, as an integrated package if you give, then it becomes a property, plant and equipment. Land in location 1, they purchased a plot of land on the outskirts of a major city. The area has mainly low cost public housing and very limited public transport facilities. The government has plans to develop the area to an industrial park in 5 years and is expected to greatly appreciate in value if the government proceeds with the plan. A Limited has not decided what to do with the property. If it is undecided and if it is land, we will classify it as investment property only. Then a portion of land has been leased out to C Limited for its manufacturing operations. Land has been given on lease rental of 10 lakhs per annum with a lease year term of 25 years. So this is again an investment property. A portion of land has been given on rent to D Limited, which has constructed a petrol pump on such land. It has been leased for a period of 40 years and renewed for a further period of 40 years. Again, this also is investment property. What they do on the land is a very different thing, because D Limited has constructed a pump, we have not constructed the pump, so this again is an investment property. So let us see. A Limited building, out of 15, 3 are occupied, so 3 is owner occupied and remaining is investment property. Flats in township 1. In case the flats are held for earning renters, it would be classified as an investment property, and if they are held for allotment to future employees, it would be part of PPE. Now, the question clearly says that they don't have the intention to give it out on allotting to the employees or selling. So most likely they will give it out on rent and it will be investment property. Then 350 flats given on rent, of course property, investment property. 400 flats which are given for self-employed 400 flats which are given for employees, that is your property, plant and equipment, and for the remaining flats we have to again decide the process. Rooms have been let out, so only rooms have been let out, and also they are charging small sums for other services, hence that is still an investment property. Land is an investment property because the purpose is not decided. Land in location 1 is also an investment property, land in location 2 is also an investment property, as we have discussed. Let's have a look at the next question. A and B establish 50-50 joint operation in the form of a separate legal entity, entity J. So, you have A, you have B, they have formed entity J. Each operator has 50% ownership interest and take 50% of the output. On formation of the operation, A contributes property with fair value of 110 and intangible asset with fair value of 10. So, A contributed 120, B also contributes 120. Okay. Carrying amount of the assets contributed by A and B are 100 and 80 respectively. So, 120 is the fair value, they have contributed equally, and 180 is their respective carrying amount. What will be the amount of any gain or loss to be recognized by A and B in the separate financial statement as well as consolidated financial statement? Now, here very simple question, 120 is the fair value, 100 is the carrying amount. If you see 20 is the profit, but 20 is the profit pertaining to our share and the other party share, because out of this, if you look at J's balance sheet, for example, 120 is one asset, 120 is another asset. Out of this 120, A will again say 60 is my share, here also A will say 60 is my share. Now, on my own share I will not have any profit, correct? So, we need to see what is the unrealized portion of the profit. So, total asset is 240, out of 240, A controls 120, B controls 120. A controls 120, B controls 120. Against this, how much of asset we have given? A has given 100, B has also given 100, right? But this 100 represents entire 100%. Out of that, again 50% I will recognize in my own books, for which I cannot recognize the gain, basically the unrealized portion of the gain. What is the unrealized portion of the gain? Out of 20, 10 is realized, 10 is unrealized. Why 10 is unrealized? Because 10 pertains to our own share. So, you will reduce the 10 of unrealized profit. Here 120, sorry, this is not 100, this is 80. Out of this, what is the unrealized profit? 40 is there, so 20 is the unrealized profit. So, share in assets 120, 120. Out of that, our carrying amount of 100, that makes a gain of 20, but we have an unrealized gain of 10, so the net gain is 10. Here 120 minus 80, that makes it 40, 40 minus 20, 20 becomes the gain, right? So, that is how we can calculate the gain. Or the other way to do that is, what has A given? A has given asset worth 100. So, asset given up, how much is that? 100. Out of this 100, what is my share? 50. What is the other party share? 50. So, I have given up only 50%, that is 50. What did I get in return? What is the asset share that will get in return? See, of my asset, if you look at A's balance sheet, of my asset of 100, I will continue to recognize 50 in my balance sheet. 50 is what I will de-recognize, but what the other party has given, out of that I will recognize 60. Out of that I will recognize 60. So, 60 minus 50, I have given up 50, I got a share of 60, 10 becomes the profit. So, in one of these two ways you can calculate the profit made by the joint operator A and B, right. Now, here please remember there is no cash flow, there is no cash movement, it is more like investment. So, from the point of view of A is passing an entry for investment in joint operation, same way B is also passing entry from the point of view of investment in joint operation. Now, if I change this example slightly, say for example, the carrying amount is 100 and fair value is 120 for A, here the carrying amount is 80, fair value is 140 for B. So, why they will contribute different, in different proportions, maybe that is the arrangement. Now, in that case, if you look at A from A's point of view, A has given up asset worth 50, A has given up asset worth 50, in return they will get asset worth how much? 50% of 140, that is 70, so 20 will be the gain for them. From B's point of view, they have given up asset worth 40, they will get asset worth 80, from their point of view also 20 would be the gain. Now, if you have to calculate it in the other way, that is total 260, out of 260 A's share is 130, out of 250 A's share is 130, asset given up is 100, so you have 30 and unrealized profit is 10, so 20 is the gain to be recognized, right. Now, let us look at the next one. On 31st March of year 1, Jackson Limited purchased 80% of the equity of Kaplan Limited for 190 million. So, this is the purchase price. Okay. Fair value of the net asset of Kaplan Limited that were included in the consolidated balance sheet of Jackson on 31st March of year 1 were measured at 200 million. So, 200 million is the net asset, amount paid is 190 for 80% stake. Okay. It is the group policy to value NCI in subsidiaries at the date of acquisition at its proportionate share of fair value of the identifiable net asset. So, net asset is 200. So, purchase consideration 190, NCI how much? 20% of 200, which is 40. So, 230 is the total. Net asset 200, goodwill is 30. Okay. On 31st March of year 4, Jackson Limited carried out annual review of the goodwill on consolidation of Kaplan for evidence of impairment. No impairment had been evident when the reviews were carried out on year 2 and year 3. The review involved allocating the assets of Kaplan Limited into 3 CGU and computing the value in use of each unit. Carrying value of the individual units before any impairment are given below. So, basically whatever assets were acquired from Kaplan Limited, we allocated them to 3 units CGU A, B and C. So, here you have intangible asset 30, here 10. Property, plant and equipment 80, 50 and 60. Current assets total value in use 180, 66, 104. It was not possible to meaningfully allocate the goodwill on consolidation to the individual CGU, but all other net assets of Kaplan Limited are allocated in the table shown below. So, the net assets of 200 have been allocated here, whereas the goodwill component has not been allocated. The intangible asset of Kaplan Limited have no ascertainable market value, but all the current assets have a market value that is at least equal to their carrying amount. So, intangible we could not ascertain, but all the current assets, these current assets have the fair value which is at least equal to the carrying amount. The value in use of Kaplan Limited as a single CGU unit on 31st March is 350 million. So, for entire unit here the valuation is 350 unit. Recommend the treatment of impairment of goodwill. So, now here you have to see what is the goodwill impairment, whether goodwill has been impaired or not. Now, because goodwill cannot be allocated to respective units, what we will do is we will first see whether each of these units are independently impaired or not. Okay. And then we will see whether the goodwill has been impaired or not, and then we will see how to allocate the impairment balance to the remaining assets. Now, A, if you see, value in use of unit is greater than the carrying amount, so there is no impairment here. Here there is impairment, here there is no impairment. So, 90 minus 66, you have impairment. How much is the impairment? 90 minus 66, we have an impairment of 24. Now, out of this 24 of impairment loss, how do we allocate? We have to allocate between intangible asset and PPE. Now, here they have said they have no ascertainable market value, but that does not mean it is not value. There is value, but we could not determine. So, this 24 of loss will be allocated between these two in the ratio of 1:5. So, if you do 24 into 1 by 6, you get 4 and 20. 10 minus 4, you will have 6 here. 50 minus 20, you will have 30 here. So, this will be 30, the carrying amount becomes 66, and this is not impaired, right. Now, if you see the carrying amount, it is 170, 66 and 100. 170 plus 66 plus 100, this is without goodwill. Okay. So, 170 plus 66, 170 plus 100, 270, 270 plus 66, we have 336 plus you have goodwill. Now, goodwill, please remember, proportionate method is 30. Proportionate method, it is 30. We have to gross up. Why do we need to gross up? Because the value in use of Kaplan Limited includes 100%. So, this goodwill also needs to be grossed up. So, if 30 represents 80%, how much is 100%? So, basically we will do 30 into 100 divided by 80, you get 37.5. So, 336 plus 37.5, you get 373.5, which is 373.5. Now, this 373.5, when I compare with what is the thing 350, there is an impairment loss. What is the impairment loss? 373.5 minus 350, you have 23.5 of impairment loss. Now, this is greater than the value of grossed up value of goodwill. So, the entire amount will be written off against goodwill, right. So, that is how you have to calculate the thing. Again, one more thing you have to keep in mind, this 23.5 is total loss. So, 80% will be reduced from parent and 20% is attributable to goodwill of NCI, which is anyways not recognized in the books. So, let us see the solution. 30 million of goodwill we have calculated, Then impairment of 24 million we have calculated, then allocated 4 and 20, that is already we have done. Then goodwill 37.5. How did it become 37.5? Whenever there is proportionate share consolidation, please remember you have to gross up goodwill because you have to calculate 100% of the goodwill. So 37.5 is the 100% of goodwill. Impairment loss we calculated 23.5. So revised value of goodwill becomes 14. Please remember 14 will not be shown in the balance sheet. Sir, how much will be shown in the balance sheet? We will show only our share, that is 14 into 80%. 14 into 80%, that is 11.2. 11.2 is what we will be showing in the balance sheet. See, goodwill in the balance sheet will be 11.2. Remaining assets or remaining CGU will not be impaired. That is about this question. Arunachalam Limited operates a defined retirement benefit plan, for its current and former employees. Given the large size of the company, it engaged a firm of actuaries for advice on the contribution levels and overall liabilities on the plan to pay benefits. Following details are given. On 1st April of year 1, actual valuation of the present value of the defined benefit obligation was 15 crores. So, actual valuation of DBO is 15 crores to the liability, opening liability. On the same date, the fair value of assets on the plan was 13 crores. So, liability 15, asset 13, net liability of 2. The annual market yield based on government bond is 5%. So, this is the expected return. During the year 31st March of year 2, Arunachalam made contributions of 1.75 crore into the plan and the plan paid out benefits of 1.05 crores to the retired members. So, you contributed 1.75, you paid out 1.05. So, when you contribute, it increases the plan assets. When you pay out, it reduces the plan assets and also the liabilities. Assuming both these payments were made on 31st of March. The actuarial firm estimated that current service cost for the year is 1.55. So, this will increase my liability. On 20th February of year 2, the rules of the plan were amended with retrospective effect, which led to the increase in the present value of defined benefit obligation of 37.5. This is my past service cost. This will also increase my liability. During the year ended 31st March of year 2, Arunachalam was in negotiation with employee representatives regarding plan redundancies. These negotiations were completed shortly before the year end and the redundancy packages were agreed. The impact of these redundancies was to reduce the present value of the obligation by 2 crores, reduction in liability by 2 crores. Before 31st March of year 2, Arunachalam made payment of 1.875 crores to the employees affected by the redundancies in compensation for a curtailment of their benefit. So, you will reduce the liability and you have also made payment of 1.875. So, that is an outflow reduction in asset. These payments were made of the assets of the retirement benefit plan. On 31st March of year 2, present value of DBO was 17 crores and the fair value of asset was 14 crores. Discuss how the above will be accounted in the books of Arunachalam for the year ended year 1, year 2 and give the extracts of financial statement affected due to the above transaction. Very simple. If you have gone through the lectures properly, in fact, the entire Ind AS 19 8 hours of content is available for free on YouTube. You can actually have a look at it, the detailed explanation. Follow the simple structure format that I have discussed in the class. You understand where liabilities will be increased, where liabilities will be decreased, where asset will be increased, where asset will be decreased. So, you will prepare a statement showing what is my opening liability and asset. Expected return will increase my asset. Cost, interest cost will increase my liability. Then I will calculate what is the service cost, past service cost, payouts and all of that. Then I will see what is the closing balance. If there is any difference, that is the difference because of difference between actual returns and expected returns, and also there could be cases of actuarial gains or losses. Now here actual gains or losses are not given, they have given this information. So simply what we can do is, we can prepare the statement showing opening and closing balances and then show the extracts of the financial statement. The RTP is given in a ledger format, but statement format would be more easy, increase and decrease, and you can prepare in that format also. Balance brought forward, which is given in the question. Current service cost, as I told you, it increases my liability, so you will add. Interest cost 75 on the opening balance. Interest cost will increase my liability. Return on plan asset will increase my asset. Past service cost 37.5 will increase my liability. Then whatever benefits have been paid, that will reduce my liability. This will also reduce my asset. Defined benefit obligation paid will reduce my asset. So there is a settlement which says we will reduce the DBO by 2 crores. So that will reduce my obligations, I will reduce that. And on the other hand, corresponding impact is payment on account of curtailment and settlement 187.5. So that again will reduce my plan asset because I have paid that amount. Then for plan asset, brought forward balance 1300 expected return, whatever is the expected return, that will increase my plan asset. Then contribution that is made by the entity, that will increase my plan asset. Please remember, when I make contribution, it will not impact my liability, but when I make settlement, it will impact both my liability as well as my asset. So why both? Because when I am making a settlement, I have to reduce my asset and I have to reduce my liability. My obligations are going down, my asset balance is also going down, right? Now whatever is the difference here, that is the difference on account of actuarial gains or losses. Because we do not have information on actual return and plan return, we will assume this is the return that is considered to be both expected and actual. So whatever is the difference is the balancing figure, which is actuarial loss or actuarial gain. Now how do we identify whether it is an actuarial loss or actuarial gain? Say if my obligation is more than expected, then it is a loss. If my obligation is less than expected, then it is a gain. Now here, if you see obligation, if you see 1500, 155, if you add all of this side and subtract all of these, there is a shortfall of 237, meaning to say the obligation has gone up. The obligation has gone up, that is a loss. Similarly, on the plan asset there is a gain, right? Now same way you can prepare it in a tabular format as well, there is no problem, right? Now in the balance sheet, what all will we show? In the balance sheet we will show what is our DBO, what is our plan asset net, then what is the P&L impact, current service cost as given in the question, past service cost as given in the question, gain on settlement. What is this gain on settlement? We have settled something with the employees, we have reduced the liability by 187.5 and we have paid 200. We have reduced the liability by 200 and we have paid 187.5, there is a gain. So that is a reduction in the cost. And net interest on the opening amount, that is obligation and the plan asset, that will be taken to P&L. So that is the amount taken to the P&L. And actual gains or losses will be disclosed in the other comprehensive income. And also the difference on account of plan assets, that is the return being more. So here plan asset actually is not an actual gain, it is a return difference. We expected some return, we got more return. The difference between actual and plan return is also taken to the other comprehensive income. So that is the disclosure requirement. So let's have a look at the next question on Ind AS 115. On 1st of April of year 1, entity X enters into a contract with entity Y to sell mobile chargers for Rs 100 per charger. As per the terms of the contract, if entity Y purchases more than 1000 chargers till year 2, the price per charger will be retrospectively reduced to 90 per unit. So earlier you have to pay 100, now it will be reduced to 90. Till September year 1, entity X sold 95 chargers to entity Y. So till September, so much is sold. Entity X estimates that entity Y's purchases by March year 2 will not exceed the required threshold of 1000 chargers. So they sold 95 chargers. Of course, when you have to buy 1000 chargers, it will not exceed. So they have made that estimate. In October year 1, entity Y acquires another entity C, and from October to December, entity X sells additional 600 chargers to entity Y. Due to these developments, entity X estimates that purchases of entity Y will exceed 1000 chargers threshold for the period, and therefore it will be required to retrospectively reduce the price to 90. Analyze the above scenario in the light of Ind AS 115 and show how revenue should be recognized in such a situation. So when did we enter into a contract? 1st of April. X is the seller, Y is the buyer. Okay. Now Y said I will buy 1000. If you buy 1000, you will get price at 90. Till September, they sold only 95 chargers, and entity X, so we are talking about entity X, okay, entity X believes that entity Y will not be able to meet the quantitative thresholds and hence discount will not be given. So till September, whatever you have sold, that is 95 chargers, you will recognize revenue at 100. Subsequently, what happened? They sold additional chargers after acquisition of entity C. So entity Y acquired entity C, because of which the volume went up. Now because the volume went up, what happened? Now they have sold 600 chargers in December, till December year 1. So from October to December, they sold how many chargers? They sold 600 chargers, and plus you have already sold up to September 95 chargers. So 695 chargers have been sold. Now this 695 should be recognized at how much? 90. So 695 into 90, you get 62550. This should be the cumulative revenue. Now how much revenue is already recognized? We have recognized 95 into 100, 9500. So 62550 minus 9500, 53050 should be the revenue that is to be recognized. So, sale of 600 chargers. So, here you can see revenue to be recognized is 53050. Now, here some theoretical explanation now depends on the marks. If it is a 3 or 4 mark question, detailed theoretical explanation is not required. If it comes for 8 or 10 marks, then you have to explain something in theory. So, Ind AS 115 states that an entity shall include in the transaction price some or all of the amount of variable consideration estimated only to the extent that it is highly probable that significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty associated with the variable consideration is subsequently resolved. This statement I would have repeated 10 or 15 times in the class itself, right? So, shall I include the variable consideration, that is 10 rupee? I should include if there is a certainty that there will not be any reversal in the future. So, till September there was no uncertainty. So, till September it was likely that it will not reverse, right? Now, if it will not reverse, we recognize revenue at 100, right? This paragraph you can exclude, there is nothing much. So, if entity X concludes that it is highly probable that a significant reversal in the cumulative amount of revenue recognized will not occur, then the entity will recognize revenue of 9,500 as on 30th of September for the half year ended. Subsequently, what happened? There are additional facts, there is additional information, and now it appears that the consideration will have to be reversed because the volume is likely to exceed 1000, right? Hence, due to change in circumstances on account of entity Y acquiring entity C and consequential increase in the sale of charges to entity Y, entity X estimates that entity Y purchases will exceed 1000 charges, and therefore it will be required to retrospectively reduce the price to rupees 90. So, you can calculate the reversal either in the way which I did, that is more logical, or in this manner, right. Now, Ind AS 41, this is with agriculture. Mr. M. Chinnaswamy and Brothers is a company that is engaged in growing and maintaining coconut palms and selling their output to various forms. The company has farmland having 2 lakhs coconut palms in the coastal area of Karnataka near Mangalore. The fair value of each coconut palm is derived based on average realizable price of 30 per nut. Okay, there is always this discussion whether coconut is a nut or a fruit or a juice, whatever you say. Each coconut palm grows 80 nuts per annum on an average basis. Each coconut palm can generate revenue for as long as 80 years, and the current palms are only 20 years old. So, 8 years is the life, 20 years is what is lapsed. Management thinks that considering the risk factor in business, valuation of each palm can be considered at 5 times its annual revenue. So, value of the palm will be how much? 5 times the annual revenue. What is the annual revenue? 80 is what they said, right? 80 nuts, okay? 80 nuts into 30 into 5. So, 8 3 is a 2, 2400 into 5, that is 12,000, okay? During August of year 5, Ooty Hotel Association chairman and his team visited the corporate office of the company at Mangalore. The deal was to supply tender coconuts to Ooty hotels at an agreed price throughout the year. The agreement came into effect from 1st of September of year 5, whereby the company shall reserve 15,000 coconut palms out of 2 lakh coconut palms for OHA and will charge a concessional rate of 15 only per nut supplied to OHA. OHA will in turn supply the tender coconuts to each Ooty hotel at the same price. This contract price is applicable irrespective of the ownership of the palm trees. All tender coconuts of these 15,000 coconut palms were used by OHA irrespective of the agreement being effective from 1st of September of year 5. What will be the valuation of 2 lakh coconut palms in the company's farm for the quarter ended 30th September of year 5? Now, what we are required to calculate is, now here what we are required to calculate is valuation for this 2 lakh coconut palms. Now, please remember valuation, when we do the valuation of biological asset or agriculture produce. Now, in this case, to be specific, these are bearer plants, and bearer plants are covered under Ind AS 16 and not under Ind AS 19. That is the first thing. But anyways, when it comes to valuation, the valuation they have said is annual revenue multiplied by 5. Now, we have 2 lakh coconut palms. Can I say that the 15,000 coconut palms, what am I selling at rupees 15? Is that the fair valuation for all the palm trees? No. So, I will split that into 2, 15,000 and balance 1,85,000. 1,85,000 palm trees, whatever is there, that I will continue to value at 80 into 30 into 5. And 15,000 palm trees I will value at 15,000 into 15 into 80 into 5. So this sum total will be the valuation of the coconut palm trees. So 15 into 80 into 15 into 5 and 185 into 80 into 30 into 5. So that is the valuation of the palm. Next one, this is not Ind AS 19, this is 37. On 1st of January of year 2, the directors of Johansson Limited decided to terminate production at one of the company's division. The decision was publicly announced on 31st of January. The activities of decision were gradually reduced from 1st of April and closure is expected to be completed by 30th of September. Okay, so this is the date of communication. At 31st of January, the directors prepared the following estimates of the financial implication. Redundancy cost initially estimated at 2 million. Further expenditure of 8 lakh will be necessary to retrain the employees who will be affected by the closure but remain with Johansson in different divisions. These retraining will begin in early year 2. Latest estimates are that the redundancy cost will be 1.9 with retraining cost of 8.5. So now, please remember, for what do we need to create liability? As far as the Ind AS 37 is concerned, for redundancy cost that you are obliged to pay, for that is 2 million, for this you will create a liability, whereas this training cost will not be considered to be a liability, or you will not create a liability because you are not required or there is no obligation to retrain, hence this will not be covered. Okay. Plant and equipment have an expected carrying value of 8 million, we will have a recoverable amount of 1.5 million. These estimates remain valid. So, recoverable amount 1.5, carrying amount 8. So, what is the recoverable amount? 1.5. There is an impairment, so you have to provide impairment for that. The division is under contract to supply goods to a customer for the next 3 years at predetermined price. It will be necessary to pay compensation of 6 lakhs to this customer. Compensation actually paid in May is 5.5. So, initially we will say 6 lakhs. Subsequent revision 5.5, 50,000 will be reversed and recognized as gain. The division will make operating losses of 3 lakhs per month in the first 3 months and 2 lakhs per month in the next 3 months, year 2, year 3. Estimate proved accurate for April and May, year 2. So, this is the future operating losses. Now, here the question talks about future operating losses. We will not provide for any future operating losses for the division. The division operates from a leasehold premise. The lease is a non-cancelable operating lease with an unexpired terms of 5 years from 31st March of year 2. The annual lease rentals payable on 31st March in arrears are 1.5 million. The landlord is not prepared to discuss an early termination payment. So, now you have to pay how much? 1.5 million annual lease rental for the next 5 years. So, you have to pay 1.5 into 5 years, 7.5 total outflow. Now, what is today's liability? This 1.5 into 5, you have to calculate the present value. So, they have given the present value table here, we will use that to calculate. Following the closure of the division, it is estimated that Johansson Limited would be able to sublet the property from 1st of October. Oh, okay, so there is a sublet also. Johansson Limited could expect to receive a rental of 3 lakhs for 6 months period from 1st October to 31st March and then annual rentals of 5 lakhs for each period ending 31st March to 31st March of year 7. All rentals will be received in arrears. I have to pay 1.5 million to the landlord. There is a burden on me. How much am I expected to recover? I am expected to recover 3 lakhs. I am expected to recover 3 lakhs for the 6 months period from October to March and 5 lakhs for each period ending 31st March year 4 to year 7. So, here there is a burden on me. I cannot escape the contract. But what is the net cost of fulfilling the contract? Whatever I have to pay minus whatever I am receiving here. So, the net amount of that will be discounted and for that we will calculate the present value. That is the value of liability that we will be recognizing. Compute the amount that will be included in the P&L for the year ended 31st March of year 2 in respect of the decision to close the division of Johansson Limited. So, first one, redundancy cost. Now, what is the question about on 31st of March? Now, if you see redundancy cost, initially they said estimated 2 million, but by 31st March, how much is the redundancy cost? 1.9 million. So, we will recognize a cost of 1.9 million, right? Retraining cost, we will not consider. Then, impairment of plant, 6.5 million, that also needs to be provided, though it's not a part of restructuring provision. Then, compensation of breach of contract, they settle at 5.5, redundancy cost, 5.5 lakhs will be recognized. Now, it depends. If on 31st of March, for 31st of March of balance sheet and 31st of May, is it a subsequent event or not? Okay, if it is it an adjusting event or not? If it is not an adjusting event, we will not adjust. But here, because information is not given, we will assume it's an adjusting event and we will provide for 5.5 lakhs. Then, no charge is recognized with respect to future operating losses. That is very clear. Then, If there is an onerous contract which is burdensome, which one is the burdensome contract? You have to pay to the landlord, right? For that, provision is made for lower of the expected net cost of fulfilling the contract and cost of early termination. So there is no early termination. Landlord wants full payment. So what is the net cost of fulfilling the contract? 1.5 into 4.32, basically 15 lakhs that you have to pay over a period of next 5 years, that is 4.32 plus minus 0.3 million that you will that you will realize in the next 1 year's time, that is by the end of the first year, and 0.5 million that you will recognize or that you will get over the next 4 years. So 0.5 into 4.32 minus 0.95. Now the reason why it is done, that is for 0.5 million the discounting should happen from year 2 to year 5, 2, 3, 4, 5 for 4 year period. That is why we are doing 4.32 minus 0.95. So that gives us the present value of the obligation that needs to be recognized as far as the onerous contract is concerned. Next one, entity X, a utility company, enters into a contract for 20 years with entity Y, a power company, to purchase all of electricity produced by new solar power station. The solar power station is explicitly specified in the contract and entity Y has no substitution right. Entity Y owns the solar power station and will receive tax credits relating to the construction and ownership of the solar power station, and entity X will receive renewable energy credit that accrue from the use of the solar power station. So now entity X, same question, it's from the study material only. Entity Y. Entity Y is a power company. Entity X will purchase power. Entire supply of power will be done by entity X by a new solar power station. Solar power station is explicitly specified in the contract. So, okay. And Y has no substitution right. So, entity Y cannot substitute the power plant. We are buying all the power from entity Y, the output. Entity Y will receive tax credits relating to the construction and ownership of the power plant. So, from ownership, whatever is the benefit, who will get? Entity Y will get. And entity X will receive renewable energy credit that accrue from the use of solar power station. So, by use, so when we talk about lease, we say there is a right to control the use, and whoever is using, so if you have right to control the use, you have to also see who gets the benefit from the use. So the power is received by X, the benefit of using, that is the credits, energy credits, that also comes to X, and the question is whether X has the right to obtain substantially all of the economic benefits from the solar power station during the period of arrangement. See, there are usage benefits and there are ownership benefit. Ownership benefit owner will get, usage benefit the user is getting, and hence we can say that it has the right to obtain substantially all of the economic benefits from the solar power station, and it is an identified asset, and hence it will be a part of the lease arrangement as far as Ind AS 116 is concerned. So as you can see, to control the use of an identified asset, a customer is required to have the right to obtain substantially all of the economic benefits from use of the asset through the period. A customer can obtain economic benefits of an asset by using directly or indirectly in many ways, such as by using or holding or subleasing the asset. Economic benefit from the use of an asset include primary and byproducts and other economic benefits. In the given case, entity X has a right to obtain substantially all of the economic benefits from the use of the solar power station over the 20-year period because it obtains the electricity produced by the power station and renewable energy credit. The credits in form of tax credit is more from the point of view of an ownership benefit, that is not something related to benefits derived from using that particular asset. Now that brings us to the end of RTP of November 2023. This RTP has been very different as compared to all previous RTPs. You would have seen lot of unique questions, and it is important that you practice all of these questions in detail.